A 1031 exchange is a powerful tax deferral tool for real estate investors. Here's a breakdown of what it is, how it works, and why it matters. What is a 1031 exchange? It is named after the Section 1031 of the IRS tax code, which allows an investor to defer paying capital gains taxes when they sell an investment property, as long as they reinvest the proceeds into a like-kind property within certain timeframes. This means no taxes are due at the time of the sale. More equity stays in play to invest in a new property, and the investor can build long-term wealth by rolling gains into bigger and better properties. What qualifies for a 1031 exchange? To qualify, the following must be true. Number 1, property type. Both the property being sold and the one being purchased must be for investment or business use, not primary residences. Residential rentals, commercial properties, and even land all qualify. Like kind doesn't mean exact type, just that both properties are for investment. Number 2, you must use a qualified intermediary, otherwise known as a QI. The seller cannot touch the funds from the sale. A QI holds the money and transfers it into the replacement property. Timing rules to know. These are critical and can't be missed. 45-day rule. You have 45 calendar days from the sale of your investment property to identify up to 3 replacement properties in writing. You also have what's known as the 180-day rule. You have 180 days total from the date of the sale to close on one or more of the identified properties. These timelines run concurrently, not consecutively. So day 46 is not day 1 of the 180. If you are nervous about finding the next property but confident on selling your current one, then use the strategy I like to call a reverse 1031. Basically, you find the new property first and get that under contract subject to selling the first one and to it being a 1031 exchange. Here's an example. Let's say a landlord in Ashburn sells their rental townhouse for $650,000 and nets a $250,000 capital gain. Instead of paying 20 to 30% in taxes, which is the capital gains plus depreciation recapture, they roll the full amount into a $750,000 rental in Arlington. The result? They revert the tax, get a higher rent property, and increase their long-term returns. Why investors love it? It keeps your money working for you instead of losing 20 to 30% of profits to the IRS. You get to use 100% of your equity to reinvest into a larger property. You can trade up from a single-family rental to a duplex, triplex, or even a commercial building. Build wealth over time. Many investors do multiple exchanges over decades, calling a swap till you drop strategy. And when they pass away, their heirs receive a stepped-up basis and taxes may be eliminated with this strategy. Key considerations. Use a qualified intermediary before you close. You can't retroactively start a 1031 exchange. The replacement property must be of equal or greater value to fully defer taxes. It doesn't eliminate taxes, it defers them. But that deferment can be indefinite if managed properly. Professional guidance is a must. I always recommend that you consult a CPA and a 1031 facilitator, and a realtor who's experienced with this like me. So if you're interested in trading up your real estate portfolio, call me today, Donna Chong with the Fox Homes team.